We'll close out this Friday's show with our final thoughts on the session. We had quite a few headlines today, but my takeaways are on the data that we got this morning. We wrapped up 2025 on a softer note in the labor market as our December jobs number came in lighter than expected. Non-farm payrolls rose by just 50,000, missing forecasts and giving us one of the weakest months of the year. Now, despite slower hiring, the unemployment rate unexpectedly fell to 4.4%, highlighting this mixed picture of a labor market where companies are slow to hire but not actively cutting jobs, this low hire, low fire job market we all keep talking about. Revisions showing payroll growth was also weaker than previously reported in the prior months. With those adjustments, the average job gains for all of 2025 fell to just 49,000 per month. That marks one of the weakest non-recession year we've had since 2003. Wage growth, though, held firm, leaving policymakers with some mixed signals as they try to assess whether further interest rate cuts are needed. We also got the University of Michigan's consumer sentiment results today. Despite that mixed jobs report, Americans are feeling slightly better about the economy as they're heading into this new year. Consumer confidence improved to its highest level in 4 months, coming in at 54, though expectations for inflation remain elevated both near term and over the next several years. Despite steady spending, households continue to feel pressure from those high prices and that labor market that does appear to still be uncertain, with many expecting job conditions to weaken. Now, this report not given nearly as much weight as any government data, but this mixed backdrop, we received today will likely add to the Federal Reserve's caution as inflation has cooled but does still remain above target. Policymakers waiting for some clearer signals on growth and employment. The expectation for a rate cut this month now sits at just 5%, according to the Fed Tool Tracker. Now, Sam, what caught your eye during the session today?
Well, you know what, Marley? We were waiting for an update on President Trump's tariffs from the Supreme Court this morning, but no ruling was issued today. The reason that the markets are watching this so closely is because it could have wide-ranging implications for trade relationships and the domestic fiscal situation. The fixed income team over at Charles Schwab telling me today they're keeping an eye on this because it could affect Treasury supply. The markets appear to be positioned right now for a ruling against the administration. So the question is where the money comes from and how it will be refunded. So in that case, this is deemed illegal. The expectation is yields could go higher on more issuance to fund it if that is the case. Now, home building stocks caught my attention. Lennar, D.R. Horton up again today. The administration ordering Freddie and Fannie to buy $200 billion in mortgage bonds to help push rates lower. The expectation is that it should lead to somewhat lower yields, but we actually saw the opposite reaction in the market earlier this morning, yields moving to the upside. So we are waiting to see if this is indeed going to have the desired effect that the government wants, Marley. But heading into next week, what will you be looking out for?
Earnings. We were just talking about this with Alex Coffey. We're going to get the big banks sort of kicking off our earnings season here Tuesday. We'll get J.P. Morgan Chase and Bank of New York Mellon for that first look. And, of course, Jamie Dimon always has some interesting commentary that tends to move the markets a little bit. But that'll also give us a preview of what we might be able to expect from some of the financials this quarter. We'll also get results from Delta. On Wednesday, we'll get Wells Fargo, Citigroup, Bank of America all in the morning, followed by Morgan Stanley and Goldman Sachs and BlackRock on Thursday. That day, we'll also get Taiwan Semi's number. Then Friday, we'll start to hear from some of those regional banks and wrap up what will hopefully be an exciting week of results. Sam, how about you?
Oh, absolutely. And as Alex pointed out, I mean, some of the tone setters as well for the broader industry we'll be hearing from. But, you know, obviously we're going to be looking at the macro as well. We've got a lot of data to get across to, as you mentioned earlier today. We've got inflation, we've got retail sales. You know, with that CPI, obviously we're going to be paying a lot of attention to that because the November consumer prices rose at 2.7% year on year, which was lower than the market was expecting. But some are saying that perhaps that was somewhat a little bit skewed because of the fact that we didn't get all that data collected due to the government shutdown. So many out there in the markets are looking for a lot more of a cleaner print to give us an idea of exactly where we're heading with respect to inflation. We had David Wu who was suggesting it could look hot, but who knows? Let's see, because of course this will feed into how the Fed is thinking about things, particularly off the back of the mixed jobs report earlier today. Now, of course, we'll also be getting as far as international markets are concerned, China trade, which everybody focuses on because, of course, we are seeing China running a more than $1 trillion trade surplus with the rest of the world. And, of course, the exports have been the one bright spot in the Chinese economy, really helping things along, which has really been feeding into the government's calculus as far as how much stimulus they're actually going to be releasing. But obviously, this is something we pay attention to, particularly with respect to how much is coming into the US. Remembering those numbers out yesterday, Marley had been suggesting there seems to be more exports than what they're actually bringing into the country right now because of some of those tariffs. So let's wait and see what the Chinese numbers say.
Lots for us to keep our eyes on next week, but that's going to do it for us today on Market on Close.